So hello everyone. Just waiting for the numbers to settle, and thank you very much for joining us on this, which is one of our last webinars of the year. This has been recorded on the 7th of November, and it's going to basically try and help you save tax before the end of the year and prepare for 2025 for all senior managers, business owners, anybody that's paying tax at the higher rate, whether this applies to you or indeed your partner. I'd like to spend the next 25 to 30 minutes just giving you some really relevant, simple things that I believe that all of us can do to basically reduce one of our largest expenses. For those of you not familiar with me, my name is Nick Shawn-Ambus, and I run a company called Alpha Wealth. We have over 10 individuals who are basically all finance professionals giving progressive advice to many different types of individuals, regardless of your position and obviously whatever stage you are of the financial cycle. I'm joined today by some of my colleagues, and Clean O'Donoghue, who's Director of Business Development, will be assisting me. And we'd encourage you to ask any questions. Please feel free to put them into the chat. We have received quite a few questions already over the last week or so. And again, if you're listening to this on recorded, and if you have any questions, please don't hesitate to reach out to us. Drop us an email and we're more than happy to answer them. So we've got lots to cover, so I'm going to go through this. And the three main things that I want to impart on you today is how to reduce the tax that you pay. I think we've got a really good opportunity for the next few weeks to do that quite effectively. The second thing is how to get your money working harder for you, whether you're saving in the short, medium, or long term. I think there's an opportunity for all of us to get a better return from our savings. And then finally, just touching on how to retire early, this notion of financial independence. And a lot of people may not even be considering what that means or what that looks like, but I think it's really important for us to take a step back and say, okay, well, let's try and get a sense of kind of where we're going, because I think if you have a roadmap, it makes it easier then on a yearly basis just to keep checking in and seeing where you are and getting independent advice. I'd like to suggest that in Alpha Wealth, we are really happy to give people guidance and advice at a very low kind of cost to anybody. And I go through that at the very end with no obligation on their part. So just in terms of tax, this slide is showing you very easily that we suffer a lot of tax. You can see that for a couple or for an individual who's earning over 150,000 a year, they pay over a third of that to the tax man. And the problem with that then is if they try and use the money that they earn to generate a return for themselves, they typically are charged more money in tax. And then when they leave the money to their children or to somebody behind them, they inevitably pay another layer of tax as well. So what can we do? Well, there's four things that I think are really important for us to consider. The first I'm going to talk about, and I don't really want to use the word pensions, but I'm going to explain to you how you can start to think about your pension as being a really effective vehicle. And there's two massive opportunities over the next few weeks to do something really effective. The second is a scheme called the Employment Investment Incentive Scheme. If anyone's been on previous webinars, they would have heard us talk about this, but this is the time really to take advantage of it because these schemes are liable to close over the next 2 to 3 weeks, and this is your limited window to get tax back for this year. Claiming on tax relief and credits, the simplest one in the toolbox, but a lot of us are still not using the Ross system. We don't have an accountant to claim for those simple things like working from home relief. And the final one I'm going to talk about is how to mitigate the tax that your children or grandchildren may suffer in the future. A really simple way of mitigating that. So on pensions, and please feel free to put any questions into the chat. As I said, we really would encourage you, and Cleaner will be, as I said to you, mining the chat throughout this. So for any business owners, any company directors, or any senior managers that are in a position where they can get their company to make a pension contribution, they can take advantage of an opportunity that's been available for the last year and 9 months, where they can pay from their company a bonus of 10, 100, 200, 500,000 euros. Now that figure may seem extreme to some people, but for any business owners out there that have money in their company, or for any senior managers that are due a bonus, I think it's a really, really important opportunity. And government has stated very clearly that this is going to close at the end of this year. And from 2025 onwards, all pension contributions will be pretty much limited to 100% of salary.
So Nick, I've a question that I just want to ask here, and please do put any questions that you want to into the Q&A. The first question is, I am an owner of a limited company and currently take 25K salary and 150K employer contributions to my PRSA. Do I need to increase my salary this year to benefit from higher contributions next year, or can I increase my salary next year to this end?
Okay, so thank you very much for the question. And again, just in terms of that, and I'm more than happy to speak directly to you around your own specific situation. Firstly, 25,000 of a salary seems very low. For all business owners, I'd suggest that you pay yourselves up to the threshold, which this year is 42,000. Now, you may have other earnings, which may be the reason why you're taking a lesser salary. The second thing to say to you is obviously, can you pay other individuals, family members, a partner, children, for example, that are over the age of 16? That's another opportunity to get money out of your business. Specifically, in answer to your question, so you have until the year end to make whatever contributions into your pension scheme that you require, as long as you use the right type of pension, which again, we can give you guidance on if you wish. But the second thing is to say to you that from January next year, it will be based on your earnings for 2025. So if you're paying yourself 50,000 next year, you can put at least 50,000 into your pension. You may have the opportunity, and this is where it's important to get advice, guys. Some employers could go back to the old regime. Now, again, I'm not going to get into too much jargon with you, but there may be an opportunity to possibly accentuate that depending on how long you've been operating this business for and how much you've been funding into a pension scheme. But again, for the mainstay, what I want to leave you with today is that take advantage now if you can. And from January onwards next year, get advice because you may be able to do more than 100% of salary, but in most cases, it will be limited to 100%. The other thing about pensions is for all of the people listening to this today and on this call, you have an ability between now, the 7th of November, and the 14th of November, which is the tax deadline, to make a personal contribution into a pension. Again, I don't like using the word pension because I want you to think of them as just a very tax efficient savings account where you can have access to your schemes, typically from the age of 50 in most cases, that will allow you to get tax-free growth. And if you make a personal contribution, you'll get money back for tax that you suffered last year in 2023. So I would encourage all of you to think about if you had some money spare now, if you haven't maximized your pension for last year, and if you're in your 30s, that would have been 20% of your salary. If you're earning 50,000, that's a figure of 10. If you're in your 40s, it's 25%. And again, we can help you very simply give you a figure of what your opportunity is. And you can do that either with your existing provider, with the company that you work with, or independently. And as independent brokers, I would be encouraging all of you to consider taking advantage of getting some independent advice because there are many different types of pensions, which I'm going to touch on in a second. The other thing that they did in the finance bill, and this was good news, is that they increased what's called the pension cap. Essentially, the maximum pension that any of us in Ireland could have had up until a week ago is 2 million euros. Thankfully, the government, for the first time in 11 years, have now increased that amount, started in 2026. So for anyone who isn't retiring before 2026, they can get a higher figure of 2.2, and obviously that'll increase every year to 2029. And it's also going to be index linked. Now, people might be looking at this thinking that that figure is astronomical, and it is a very large number. But for anyone who has a large salary and is obviously working for maybe one of the multinationals over a long period, you'd be surprised with growth and contributions from not just you, but also your employer, that you can build up a fairly sizable pension fund. And the key thing to note, guys, is that you need to be able to understand how to navigate this, particularly if you're a business owner. And if you are looking at making this lumpy contribution, as I'm asking you to consider before year end, you'll be surprised at how the growth on that, especially if it's in the right type of fund, will get you fairly close. But this is good news because it means that less of us will obviously hit that cap.
So Nick, just before you move on, just two questions that have come in. So from next year, if you pay more than 100% of income, what will the tax be on that? Or is it a hard limit that you cannot pay more than that? And is 100% cap on pension contribution for companies as well?
So it's not that it's a hard limit, it's just that you'll actually be disqualified for pension contribution. So effectively, it's just penal. And I would disencourage anyone to overpay into their pension scheme. And this is where your advisor would be able to appropriately guide you. The key other thing then is I've alluded to the fact that it isn't necessarily always capped at 100%. So, for example, I'm going to use me as an example. I set up Alpha Wealth just over 10 years ago. If I had not been contributing much into my pension scheme, and if I had drawn a fairly reasonable size salary, revenue would allow me to make up lost ground. Now, I'd be using a certain type of pension, and this is where it comes down to a bit of advice and guidance. But there may be an opportunity for me to pay more than 100%. But this is not something that I'd ask you to try and work out. You need to get a good qualified advisor that's going to steer you correctly, because it is a bit of a minefield. And I would say to you all, tread very carefully and don't just make assumptions. The other, sorry, Claire, you said there was a couple of questions. Is there any more? Or is that it?
Sorry, I just combined two of them together.
Okay, great.
And I'll keep the rest till we progress on.
One final thing to say for anybody who is working for a company where you do not have a pension scheme, and we've already spoken on a couple of webinars about auto enrollment, and we will be doing another session. The government have finally announced the actual date that auto enrollment is coming into effect. It is going to be the 30th of September 2025. The one thing I just want to leave you with today, guys, is that if you are paying tax at a high rate and you do not have a company pension, do not allow yourself to become auto enrolled. It is not going to benefit you. You're going to lose out on tax relief. You will be held to an age of 66 before you can draw the pension, whereas it's 50 for any other arrangement. And we'd be happy to give you advice and guidance, whether it applies to you or indeed if you're an employer that has employees where you are subject to some of them being at the higher tax band. It would be definitely worth your while speaking to a broker who's independent that can help you in this guidance. This graphic is talking about pension fund performance. Now, just to give you a kind of a very quick synopsis of why I wouldn't just pay money into any old pension. Not only should you be really cognizant of the fees that you pay, but these are three funds from three different providers that are in the same risk category. Zurich have a fund called Prisma 5, Irish Life called Multi-Asset Portfolio 5, and New Ireland called iFunds 5. And you can see there quite clearly that the light blue one is the best performing Zurich's. And if you look below on the, say, the 10-year performance, Zurich's performance is over 50%. Now, if you're not convinced of the fact that there is a massive differentiation of funds and fund performance and how much of a difference it can make to your pension pot, on the example here of a graphic of 50,000 growing at 4% a year versus 6%, and that's really moderate. I suggest that for anyone who has a pension, their fund performance should be higher than that, as I've just shown you. That would manifest in a difference of, in this example, over 125,000 euros. It is enormous. And I cannot emphasize for any savings that you have, make sure that it is in the best fund at the lowest fee possible and that you're getting advice. The general rule
And
of thumb for most is make sure your pension fund is fairly aggressive. The biggest mistake that a lot of our clients make is not having their pension funds in aggressive enough assets.
another question that's come in is, have pensions been index linked up to now for employees and employers, or is that something you have to choose yourself?
It is something you have to choose yourself, and it would be a good idea, obviously, in that otherwise you're going to lose out to the effect of inflation. But again, they don't necessarily have to be, automatic every year. The one thing I'd say to all of you is, get advice, but make sure that you keep checking in with an advisor. I spoke to a client yesterday who hasn't heard from their advisor in 3 years since they set up policies for them. And I said to them, shame on them, because I think that it was absolutely like desperately dreadful. I feel very strongly that all of you should be getting advice every 6 to 12 months. And if you're clients of Alpha Wealth, I feel very strongly that you would have done so. We feel very sure about the fact that we're doing webinars typically once a month. And I would suggest that you can look out for them. They're free to access. There's loads of information on our website. And we'll be very progressive in making sure that we are advising people. The second area to reduce tax is a scheme called the Employment Investment Incentive Scheme. And again, we can provide you more information, but just as a quick takeaway today, you have an ability, all of you who are suffering tax at the higher rate, to make a contribution into one of about 70 qualifying companies to get somewhere between 20 and 50% of your investment contribution back in tax that you've suffered because you're seen to be basically encouraging these companies to grow. The example on the screen there is, let's say, for example, you had 10,000 euros and the scheme has a minimum period of 4 years. You can make a contribution, the average rate of, say, 35% tax back, 3,500 back into your pocket, which is given pretty much immediately. Your money is held by that company for 4 years. That's going to help them grow. And you expect your investment capital of 10,000 back plus interest from the company. One thing I'd say to you all is be very careful of the companies you invest in. There are some very good companies and there's some very bad ones. And in Alpha Wealth, as independent brokers, we have whittled it down to two. One of them is called the Fork and Wheel. It's actually 5 Mile Concepts, the company. It's a very progressive company that is investing in a coffee company as well as a bar restaurant based in Middleton in Cork. Some people may scorn it because it's hospitality. I can suggest very strongly to you that this is a really, really strong opportunity that provides the asset, which is the building, which has been renovated to the standard that you can see on the screen there. It's opening on the 14th of November, and it's run by a really, really reputable company called Klister, who own a number of hotels, bars, and restaurants, and have performed successfully over a number of years. The second one is a renewable energy fund called BVP. They have done this over the last 13 years, quite successfully, I might add, investing in 8 or 9 renewable companies. And I like the balance between those two companies, which is why we provide a blend of the two. And again, there are different characteristics, and it's important to try and get advice around which one might suit you best. And obviously, we're more than happy to provide you information without any obligation.
And what are the fees associated with EIIS?
They can vary from companies. Some companies charge quite a lot. Some companies are not charging much at all. So, for example, BVP charge a minimum fee of 3%. So if you invested 10,000, you would suffer a 300 euros fee. For 5 Mile Concepts, we're actually charging no fee. And if people are wondering why, this is only a small part of the overall financial advice that we give people. There are products that we sell. We sell pensions. We sell investments. We do not sell health insurance, mortgages, deposits, and certain schemes that we're not looking to be remunerated for. And I suggest to all of you, it's worth getting a broker that can give you advice and guidance in all areas that relate to personal finance. And this is where I'd like to think that we can give you the value add.
And before you move on, sorry, another question on EIS has come in. Isn't the failure rate of these startups very high within the first 5 years, assuming this business is obviously a startup?
It can be, but this is why I said to you earlier that we've qualified 70 companies down to two. And in both of these companies, we feel very confident that because of the previous success of not just the trading company, but also in relation to obviously the area that they invest in. But this is why you need to be cognizant of the fact that there is risk in EIS. But in terms of an overall portfolio, if you have investable assets of 50,000, and if you are suffering tax at the higher rate, you need to, I suppose, recognize that taking a proportion of that, maybe 5 or 10,000, and selecting the appropriate company with advice from an independent advisor should give you appropriate guidance and advice around obviously what should be an appropriate investment. But yes, there are many companies that fail. The government changed EIS relief last year, where some companies are advertising a 50% tax relief, but these are companies that never traded, and I wouldn't touch them with a barge pole. The two companies that we've mentioned to you are both trading entities. The relief is capped at 35%, but to me, that's the sweet spot. Just the third area of reducing taxes, and I'm not going to spend much time on this, guys, is if you do not have an accountant, get onto the ross.ie system. It's so simple to use. I've mentioned this and I suppose, exhausted from telling people, claim on things that you spend money on the last 4 years, the revenue want you to claim back for, including rent relief that's worth 1,500 euros per individual over the last 2 years. It's being increased next year to 1,000. Claim on expenses working from home. All of us have worked from home in the last 4 years, and yet over 50% of people still haven't claimed for the 30% of their heating, lighting, phone, and expenses. And it's remiss of me not to say to you, you should do that. The way to do it is so simple. It's just a drop-down menu. It's one of the easiest things to do. We can just give you a guidance and assistance, but I would strongly encourage you to do this, guys. The final area, the fourth one that I mentioned, is gift and inheritance tax. Now, obviously, some of you may be sitting there saying, well, I'm not in a position yet to start gifting money away to people. But just one thing to take note of is that for the first time in 11 years, the government increased the gift or inheritance tax threshold from, say, a parent to a child, or from a family member to another family member. And whilst 400,000 from a parent to child may seem like a lot, if you have one or two children, and if you have a property, it's more than likely going to be worth more than the overall threshold. And especially then if you have a pension scheme and other assets, you can understand why this is causing a lot of concern. The thing that we did is we set up what was called the Alpha Savings and Investment Club that can encapsulate the fact that you can save money for your children or indeed grandchildren. And you can, that money that you put in and the growth of that falls outside of those limits. And I think it's a really useful tool. And you've got the ability to put up to 6,000 a year. And any parents that are, in any way, I suppose, exposed in this area, if you're looking to put money away for their third level education or help them to get onto the property ladder, this is an absolute no-brainer. And I can't emphasize the fact that it's a really good opportunity, even if it's just a child allowance that you're saving. Put it into the right type of vehicle, and please do not put it into the credit union or post office. They're the wrong types of accounts for that type of purpose. There is one other scheme as well, and if anyone wants to, they can just click on the QR code there, take a screen grab, on the basis that there's a second scheme that allows you to save or invest that has the dual purpose. You can use the money for yourselves for whatever it is. Maybe it's buying a holiday home, saving for the future, maybe in terms of trying to retire early with. But it can also be used to mitigate that tax that I spoke of. And it's particularly relevant for any parents who have accumulated quite a bit of wealth that are considering making investments. If you do them in your own names, you're only going to make the problem worse. If you look at schemes like the Alpha Savings Club that I mentioned, or indeed this scheme, this called Section 73, I think it would make a lot of sense.
Again, Nick, just before moving on, so another question has come in from somebody thinking that is 3,000 not the cap per year for gift tax?
It is from one person to another, but the 6,000 I mentioned obviously assumes that there might be two parents, or there may be a parent and a partner, so that any individual can give any other individual. So whether you're the direct parent, whether you're even a non-parent of that person, you can still pay 3,000 to that individual and reduce the tax. And by the way, in this age where I'm in a blended family, it might be more relevant, because if it's not a blood child, the relief the amount you can give them is only 20,000. So again, you just have to be cognizant. But to answer the point, I'm assuming that there may be two individuals giving the gift to one person.
And
Okay.
from what date does the increased inheritance tax apply?
Immediately. It's a good question. It was assumed that it might be from January, but I understand that it came into effect as soon as the finance bill was ratified, which was earlier this week. So those thresholds have kicked in straight away. Okay, just a couple of things just to finish off on. I mentioned the Alpha Savings and Investment Club. This is a really great savings scheme. It can be incorporated, as I mentioned, for that gift or inheritance tax for children or grandchildren, but also for yourselves. Every one of us should be saving for the medium to long term. I'd refer this to a 3 to 5 years plus savings scheme. This plan achieved 14.1% over the last 12 months, which is phenomenal, consistently averaging over 6% a year in the last 5 to 10 years. Total flexibility of payment, minimum €100 a month. You can put in lump sums in addition. You can pay lump sums only. We provide the lowest fees possible. We give 101% what's called allocation. So all of your money is invested because the government take a 1% levy. And it's a really great savings scheme. And I encourage all of you to at least consider it and reach out to myself and David Looney, and we can provide you advice in this scheme.
And
Shorter
before,
term.
sorry, another question, I may as well ask them just as they come up. Can you just explain the fees that are associated with the savings scheme for this, let's say if somebody wanted to invest the children's allowance?
So I mentioned about the fact that there's two forms of fees that you have to concern yourself with. One is called the allocation rate, how much of your money physically gets invested. And I've given you the answer already for 101%. The other fee that you need to concern yourself with is what's called the management charge. This is across all saving schemes in any of the insurance providers. And these schemes can vary depending on the amounts involved and in terms of whether they're a lump sum or monthly contribution. But typically for longer term savings, if it's 5 years plus, we offer a 1% management charge or 1.25% if it's monthly savings. So that's the answer to your question. Okay. Just in terms of short term, all of us have money in the bank. And the point I'd make to you is do not accept 0% returns anymore. You have an ability to put your money into instant access accounts, and you can earn currently 3.25% with two German banks. One of them is called Trade Republic, the other is called Raisin. I think that it's a really good opportunity for all of us to get used to this. So simple to set up. You get onto your phone, get onto the App Store, like you would have done if you set up a Revolut account for yourselves. So many clients I'm talking to at the moment are using Revolut for savings, and they swore to me they wouldn't. Nobody cares anymore that Revolut are Lithuanian. They shouldn't really. They are governed under the government guarantee scheme. But the reality is that their returns are not as advantageous. You can see on the screen there that the instant access savings with them was 2%. They actually reduced it to 1.7. But you can get the 3.25% with Trade Republic with no fees, and you get 24 hours notice. And I would encourage all of you, if you haven't already done so, take advantage of these opportunities. And if you're saying to me, I've never heard of Trade Republic, well, respectfully, that's on you. We've seen the advent of these banks come in. Please do not tell me that you're saving in a credit union. They pay 0% dividends. I can't understand why anyone would use a credit union. The other thing I'd say to you is don't get familiar with the AIB Bank of Ireland's of this world when it comes to deposits. I like them for regular savings. I do not like them for deposits. And going in to see the bank these days, it doesn't happen anymore. They're closing branches left, right, and center because they don't want to see you anymore. And that's the way that I think banking is going to go in general. Last thing, I mentioned about financial independence. And again, there are some webinar videos I would encourage you to watch and listen to if this is something that may resonate with you. This is a quick example of showing you that even at fairly moderate contributions of putting 1,000 away a month from the age of 25, you can reach financial independence at age 50. And again, I'm not going to get into too much detail with you, but what I'm saying is whatever stage you are in the financial life cycle, just recognize if your money's working for you, if it's in the right type of vehicle that's tax effective, and if you're taking advantage of those opportunities I spoke about earlier, reducing the tax you pay, don't take on unnecessary debt, make sure that you've got your savings working hard. I think reaching financial independence, which you can argue is retirement, but it doesn't have to be. There's this notion of what we call semi-retirement now, where you get to your mid to late 50s and you decide whether you want to continue working. And please don't tell me that you're taking the lazy road to retirement because you like what you do for a living. I'm 51 on Monday, and I'd say to all of you, as you go through the years, your time and I suppose your preference to working and deciding whether you want to continue working or not, I think becomes more poignant. So what I'm saying is get a financial broker to show you a proper projection of where you are, where you're going, what the right vehicles are, and make sure that you're applying your money in the best place possible. Just to bring it all together, I've spoken about the 4 ways in which you can reduce tax. I've talked about getting your money to work harder for you, naming counts like short-term, Trade Republic, Raisin, and obviously taking advantage of the monthly savings and only monthly savings in AIB Bank of Ireland. Looking at the Alpha Savings Club for 3 years plus, particularly when it comes to children, and thinking about that gift or inheritance tax mitigation that I've spoken about. And then finally, in relation to retiring early, which again is a topic on its own, but I would encourage you that if it's something that you're interested in, please do keep listening into our webinars and do reach out to us. Myself and David are very, very good at what we do. We've got a great team working with us. Just on the screen there, I've thrown up our next webinar, which is on the 9th of January. David's going to be doing a webinar for anyone who may be in the prospect of being made redundant, which is not a topic I want to bring up in November, but it is something that unfortunately is becoming more common for people. And again, look out for that on our website. Cleaner, I'm sure, would have probably put up on the link access to some of the webinars that you can get, and you can go into the QR code there on the screen. Finally, if anyone is interested in getting a specific consultation with us in Alpha Wealth, David or myself, and David is fantastic at what he does, we're offering a financial review to you. Basically, it's a once-off fee of $199 for anyone who is earning over 100,000 a year or has investable assets of over 100,000. That fee is $349. We will give you loads of advice over a 1-hour session, which involves us doing preparation before the review and also follow-ups after the review. And that's a once-off cost that entails as many meetings, which could incorporate 20 meetings over the next few weeks, months, years, that is captured under that one fee without any obligation. And I do encourage you, if you haven't already had a consultation with us, please do take us up on that.